Good morning. It is the day after Valentine's Day, February 15th, 2019, and there's a lot going on this Friday, so let's get right to it. First off, Amazon decides not to build in New York after opposition from a far left group of politicians, mainly local politicians, but that didn't stop AOC, Alexandria Ocasio-Cortez, the newly minted congresswoman from a district in New York, from taking some victory laps, apparently. And I think it's interesting that she has gotten some scolding from people like me, basically people who are a little left center, a little bit libertarian, and believe that markets and capitalism are the best way to the goals that even people like Ocasio-Cortez have. So, and I'll be real honest with you, I share a lot of her goal outlooks, right? A lot of things that I believe we'd like to get to, I believe the same things that she does. However, I think her tactics and her strategy are largely wrong. And I think that the way that she looks at the economy and capitalism and these socialist utopian ideas, just they don't work.
Not rooted in reality.
No, and we've talked about this before. You know, people talk about, well, you know, you have better social programs in Europe, kinda, but a lot of countries are bankrupt over there. And once the oil money runs out, you know, what are the Northern European countries going to do? Because that's where they got a lot of their money. So, or countries like Switzerland, you know, they've been a banking empire for centuries now, I guess. So, you know, a lot of social programs I believe in, and I think that a lot of us should believe in them. The safety nets, the ways to keep crime down. You know, there's just a very complex web there, right? But ultimately, everything has to be paid for eventually, and you can't just snap your fingers and have money. So, you know, I think it's interesting that she has basically used the same guerrilla social media tactics as this guy. This guy became president doing it, but I think that a lot of Americans are probably kind of past it. You know, he speaks to his base. You know, he's going to have that third of the country or quarter of the country, whatever it is, that just is die hard into him. You know, then the question is can he get the votes at the margin to win again? Who knows? I think it depends on the economy. If the economy is gangbusters next year, he's got a shot. If the economy isn't gangbusters, who knows? You know, you've got, you know, some of the media pundits out there. This one and who is, and Ann Coulter already talking about challenging Trump. So, I mean, for Ann Coulter to call somebody a lunatic, it doesn't matter to me if she's right or wrong. I just find it amusing that she's the one saying, right? Because she's nuts. Right. So, you know, I mean, and frankly, she's the evil.
Yeah, just trying to get some attention from it, I guess.
Yeah, have you followed her career much? I mean, remember, I was one of the guys that was interviewed to go work for Breitbart as a climate change denier, right? You know, and now I'm doing this with my firm, you know. So, you know, I've talked to some of the people over there. So, have you followed her at all?
Not real closely, no. I know she does say some outlandish things.
Well, and I can tell you, I know sellouts. I know people who have sold out and they just say what they have to say, you know, and then when they get yelled at in public, they're like, well, why are you bothering me? You know, but the reality is that she's a sellout. She probably doesn't believe half of the stuff she says, but she makes money saying it.
Yeah, exactly.
So, you know, we have to be careful of people like this. She is, you know, if you're watching an old movie about a circus and you had the carnies, she's a carny. She's just selling snake oil. So anyway, you know, the Financial Times and Wall Street Journal have covered this pretty well. Why Amazon is leaving New York, or they're not going to put the New York there. I'm going to show you something that I have said to her. I reply to her for quite a bit. I want most recent. I don't know if we're gonna do that. Not doing it. Well, I've responded to her and basically trying to tell her that, look, there's a way to get to the things that you want to do, but it's not always, socialism just isn't going to make the money to pay for the social programs, right? You need capitalism to pay for social programs. Yeah. And ultimately you need fair capitalism. And I don't really know where tweets and replies, is that what it's under? There you go. So here's some of my comments to her today. If you're not following me on Twitter, I put a lot of good information out there, and sometimes I'm educational, and sometimes I'm just funny. At least I think I'm funny. So if I laugh, I figure it's a win, right? But Dave reads my stuff all.
Yeah, sometimes I make me laugh.
Sometimes you make me laugh. It sounds like my girlfriend. Yeah, sometimes he makes me laugh. So in any case, things that we need to be aware of as investors when it comes to all of this politics is, can this impact us? Can this impact the markets? Well, in the very short term, probably not. But as the pendulum swings far to the right or a pendulum swings far to the left, that usually brings unintended consequences. So one of the unintended consequences of the big tax cut for the super wealthy, dropping their income tax rate from 39.6 to 37, and then cutting capital gains and giving real estate owners mainly, but also some small business, the LLC tax credits, we're going to run a record deficit this year. And I don't think that that's a platform that most Republicans want to run on, is, hey, let's run a huge deficit, bigger than anything Obama ever did, and he had a depression to get us out of. We really need to think of, okay, when times are good, a Keynesian doesn't believe in running a deficit when times are good. A Keynesian pays off bills when times are good. And so, when people call what Trump is doing Keynesian, that's not really true. The economy's been great. So why would you run deficit spending programs to grow the economy? There's a lot of things that don't jive here. Politicians borrow from one theory or one idea, and then they apply it to something that's not congruent, and then the media describes it wrong usually, and folks who will give you the true story are regulated to a YouTube channel that gets 1,000 views a week, So, I encourage people to go out there and get better information, get better economic knowledge, because supply and demand, like I said earlier in some other shows, supply and demand rules everything. Everything in life is supply and demand, from jobs to love to everything, right? I mean, if there's more women than men, that affects the price of a relationship. And if there's more men than women, that affects the price of a relationship. And I mean emotional, financial, everything that comes with a relationship. So if your relationship is with widgets, who makes the widget? Is there more widgets produced than what is demanded, or is there fewer widgets produced than what is demanded? And that just applies to everything. If you apply supply and demand to any situation, you're going to find the equilibrium, quote unquote, price, and that'll generally lead you to good decision making. Some of the things I've said to Anacosio Cortez is basically that there are things that we want to accomplish. I'm big on the climate change, and I think that Medicare for all is a good idea. But some of the bills out there, some of the ideas that they float are so complex, so convoluted, so special interest driven that they screw it up. So on the one hand, you have problems that really only a scaled up government can help with. But then on the other hand, you have politicians that just screw it up so badly that people start to throw their hands up and say, well, screw the government. Well, maybe it comes down to the citizens electing better politicians and not letting very vocal minorities, control the game. So, one of the things here that I said to her was, I support a lot of the ideas that she has, but Keynes is better than Hayek, and capitalism is better than socialism. And little things like that drive not only society, but ultimately drive the economic engine, which drives the investments that we have available to us. So just keep that all in mind. I know that people don't like me to rant on and on too much about this. I did ask, I asked Governor of Wisconsin, please offer Bezos a deal. I would love to see Amazon come to the corridor between Chicago and Milwaukee. It's about a 80, 90 mile corridor. We already have a big Amazon facility. Foxconn is coming. Is already their plant's half built. Different type of jobs, right? The Foxconn deal ended up being much different in the end than it was at the start. We probably paid double what we should have. We gave them $4 billion in credits. Should have only given $2 billion. But I got a feeling that a lot of those credits they won't achieve, so it will end up being a much smaller number. It's not going to be a manufacturing facility. It's going to end up being an R&D facility, that Foxconn deal here. And one thing that I would point out on that for all the folks in Wisconsin that are listening or will read, watch this later, that the Foxconn deal, I think, was bastardized from the beginning. They talked about manufacturing jobs because that is what would get public support. But the reality is that manufacturing is becoming more and more automated, and we've talked about how supply chains are changing and moving because automation is getting rid of a lot of people on the assembly line. And there's good and bad to that, right? We can move into higher paying jobs, but that requires retraining, which requires money, which requires time, which, a lot of people have a hard time with that uncertainty. A lot of people just want to plug and play for 35 or 40 years and then go to retirement. I get it. But, the higher end jobs that are coming to Wisconsin in the long term, those R&D jobs will be a lot more profitable. And a lot of those people will live in Chicago and need the services of Chicago, but we'll make some money on that here in Wisconsin. So for Wisconsin, to fill that corridor between Chicago and Milwaukee, put a train line in there, which for whatever reason Scott Walker didn't want, but the new governor will. That will support 3 counties in maybe 4 counties in southeast Wisconsin. It'll have jobs for the people of metropolitan Chicago and metropolitan Milwaukee. So Jeff Bezos, that's my pitch to you. We got everything you need here. We got a lake, we got water. We don't have much climate change at this point. It's getting a little warmer, but we're not going to be underwater from a flooding ocean either. So all those things impact economic development in your state, in my state, in the country. And we need to keep an eye on that so that we know what the big trends are. And, one of the big trends is clearly automation and changing of supply chains, which is kind of one of those wonky things, right, Dave? Who talks about supply chains? But really, supply chains, which I'll give President Trump some credit to, he talked about supply chains when he talked about the tariffs way back when. Supply chains are going to move anyway, though. He was talking about physically trying to move supply chains using tariffs. The reality is those supply chains are going to move anyway. Supply is going, for whatever it is you need, is going to be more local in the future because a robot doesn't make less in China than it does in America, right? A robot's a robot.
That's right.
So, all right, let's get rid of this garbage. All right, let's talk about the Fed. The Fed, I talked about way back almost a year ago now, was making 2 huge mistakes. I said they were raising interest rates too fast, and I said that they were tightening their balance sheet too much. So what did we find out in the last couple of months? They're not going to raise interest rates quite as much. And now they're talking about winding down the quantitative tightening. So I don't know what they've come up with yet, but if they don't pull down the balance sheet for the Federal Reserve, which honestly, there's no reason why they need to shrink that balance sheet. They can pay it off over 30 years like a mortgage, 50 years maybe. They don't need to do it quickly, they need to do it over basically the balance of the lifetime of the boomers. So another 30-ish years, give or take. Some boomers will live 50 years, but whatever. The average life expectancy of a boomer is around 30 years from now. And because of the demographics driving the deflationary forces in the economy, that's how long it should really take to pay down the Fed balance sheet. And in fact, the Fed balance sheet probably expands again at some point. Just a little side here. You'll see this advertisement here, Traders Expo in New York. I will actually be here. So March 10th to the 12th. I will be at the Hilton Midtown for most of the day, walking around all 3 of these days. The 10th, my girlfriend is coming to New York on the 9th with me to see a Broadway show. So she'll be there part of the day on the 10th. So I'll probably duck out for a little while. I'm staying at a hotel about a block away. But if you happen to be in the New York area, Ave Gilbert, Elliott Wave Trader will be there. I'll be hanging out near him. Forex Analytics, the people that I just did a interview with yesterday, will be there. So there's a lot of great people. I think Cody Willard will be there. I'll try to say hi to him. But I'm happy to meet up with anybody who's going to be in New York on the 10th to 12th. Just get a hold of me. Forex Analytics, I said did an interview with these guys. Dale Pinkert is the guy who interviewed me. I would follow both of these folks, if I were you. Dale's just a prince of a guy. He's just an amazing guy, and he interviews his people on his team and his and outside guests. So I've been on the show 4 or 5 times now in the last year, and we have some pretty great conversations. So if you go over to YouTube, and I will actually put this interview on my firm website. So on my firm website, you can find the webinars, and it won't just be mine. I put these in manually because I do outside interviews. So it'll be up here soon. So you can always use Blue Mound AM if you want to really get a link to anything I do. I mean, I know that a lot of you aren't interested in having me manage your money. You like to do it yourself. That's cool. But everything that I have where I have publishing is somehow on this page or links out. So there you go. We actually talked about oil. So we're going to talk about oil, but I want you to hear. Can you guys hear him, Dave?
No, I don't.
No, okay. So what he said is, will you be my Valentine, and will you take oil from up to 48 or down to 48 before it goes back up to 68?
Mm-hmm.
So what these Forex Analytics guys are taking a look at is they believe that there'll be a little pullback in oil, but then it's going to shoot all the way up to 68 quickly. I actually think it's going to shoot through 68. I think they're going to make a run at 80 like they did last year. Do they come up just short? Last year when oil was 40, I said it was going to 80, and it got to 76. This year when it was 42, I said it's going back to 80. Maybe it gets there. Maybe it just is another narrow miss. Who knows? Supply and demand. So supply and demand for 10 seconds. You can see what YouTube is recommending to me. The things that I watch. I watch Star Trek. Life of Brian, right? There you go. I must have watched a little Bruce Lee recently, but supply and demand. So YouTube's got that down in their algorithm, which is why we have to make sure that our search engine optimization is somewhat good. We talked about that before we were broadcasting. So with regard to oil, I'm not going to go through it too much, but last week we talked about all the things that were going to drive oil price up, and it really comes down to the Saudi Arabians have a lot of control of the market, and it took fooling them in the second half of next year to drive the price of oil down. So in deference to the cars, right? No, yeah, we won't be fooled again. Who's saying that?
The Who.
The Who. Did I say
yeah.
the cars? What the hell? Yeah, the who. Yeah, I don't think Saudi Arabia will be fooled again. And in fact, if you're reading the news on Saudi Arabia, they are becoming more and more belligerent by the day. So I don't think that the theory that there could be worse things happening in the Middle East at some point is wrong. I just think that it's a matter of time, and whether it's the next couple of months or the next couple of years, some bad things probably happen in the Middle East. So worth taking a look at. The Saudi Arabians are going to push oil back up towards 80 because they need it towards 80. And we will see how quickly that happens. So I don't want to spend a lot of time on oil. We talk a lot about oil. Let's talk about making money after a stock market starts to rebound. So this is a screen that covers the U.S. sector ETFs. And what you'll see over the last month, what's done the best. Solar has been the best performing over the last month. And then a whole bunch of technology. And then we get a somewhat surprising leader, industrials. And I don't even know if we can see energy on here. No. Oh, yeah, there you go. One of the leaders has apparently been oil and gas services and equipment. Now, this was beat to hell. We're not in it anymore. We used to be in this, and it just didn't do anything. So you take a look at this, and you pull up the technicals, and you look at MACD, you look at money flow, and what do you get? You see that there was a bit of a rally, and now it came off. It's losing that positive divergence on the MACD. So I just don't think that the services companies are going to, I don't see this rebound happening. And I wonder if we're even going to see this. And the reason I say that is these are very capital intensive companies with a lot of debt. So with the exploration and production companies focusing on profitability and whittling down their balance sheets, and really across the board, we're seeing all sorts of reductions in planned spending for this year. I don't know that the service companies have a whole lot in them. I think that this level here is kind of like this imaginary line, you know, from here to here, a little bit above there, and then in here. I think that this only has a little bit of upside left. The one that I like is because all these companies are looking at becoming more profitable. So the holdings in here are companies we've talked about. You know, Newfield's the top holding. That has to do with the merger. So Encana is going to end up being up in here somewhere near the top of this, and that's going to drive buying in the stock. So once Encana becomes a bigger part of XLE and XOP and IEP and the top oil and gas ETFs, that's going to drive Encana up. So let's take a look at XLE, which is market cap weighted. Encana doesn't show up anywhere on here, right? Newfield doesn't even show up on here. But when you add Newfield and Encana together, which is the merger that's going on right now, it was just approved. And did they finalize it that quick? I know it's like right on board. That's going to push them to be about this big. So they'll become about 2% of this index imminently. And this is a really good stock to buy in Encana right now because you don't even see them on this list. So this fund has to buy a whole bunch of Encana. So keep that in mind. This is going to be one of those factors that drive it. So Dave and I have been working on this one. Dave wrote this piece. And this is for subscribers, which we'll probably make public, late next week?
Yeah, I guess we could put it up.
Yeah, I think just like I said,
probably submit it midweek and then have it go up.
Yeah, Tuesday.
Yeah,
Tuesday night. I'd say submit it Tuesday night so they can get up on Wednesday. You know, what time do you get home from the day job?
After 6:30 or something like
Yeah,
that.
I would say touch it up on Monday, fire it out when you get home from work
Yeah.
on Tuesday. But Newfield and Encana, their merger, I don't think people completely understand how good of a merger this is. And when it comes down to it, Encana is going to have three awesome core assets: the Montney, the Permian, which we talk about all the time, and the Stack Scoop slash Anadarko. So it's the Anadarko Basin in Oklahoma, and then the Stack Scoop is what they call the oil that they're going after. And they also have four other assets, including in the Williston Basin, which is the Bakken, over in North Dakota. All these names for the same things, right? So it has to do with what kind of formation it is, where it is geographically. By the way, we're in this state, that sort of thing. And Encana is going to end up selling off virtually all of their non-core assets. And those non-core assets will get sold to companies that are more prominent in the basins where they're selling, and they'll be bolt-on pieces for other companies. For example, in the Bakken, they'll sell off their assets to a company like ConocoPhillips, which is big there, EOG, which is big there, maybe Continental, maybe Whiting, Exxon and Chevron are big everywhere, so maybe those guys. But they have no shortage of suitors for their non-core assets. And ultimately, Encana is going to be Texas, in the Permian, the Stack Scoop in Oklahoma, and then the Montney. And they may or may not be able to sell their other Canadian asset, which is Duvernay. So we'll see how that goes. But they are on track to make a lot of money as the oil age closes over the next decade or so. And I'm not saying oil will not be used in 10 years, but the demand growth for oil is going to turn over in that time frame. And I've showed those charts before, so I won't bore you with them again. But I am going to put up a pretty big article that shows all those charts again. So keep an eye on for that next week. I'm actually preparing that article because I'm doing an interview with Dan Dicker on Monday. So Dan Dicker is another guy who on Twitter, and honestly, I know some people don't use Twitter, but I think Twitter has a lot of value if you stay out of the political stuff, or the time wasting stuff. But Dan Dicker is one of the authorities on oil in the country, and this will be my second or third appearance on his show on Monday. I don't know if it'll go public. If he throws it out there publicly, I'll let you know. But Dan Dicker is a good guy to follow. He and I are on the same page a lot of times. My economic background might be deeper. I don't know. I think I pay attention to some things that he doesn't concern himself with because he's such a specialist. But I'm going to talk about how the geopolitics really are going to affect oil price going on, and how the strength of Saudi Arabia as the cheapest big oil producer, they're going to really drive the price of oil. And the one thing with oil is deep water has been largely crushed. If you visit Rystad's website, Rystad, R-Y-S-T-A-D, what you'll see is that the day rates have not gotten better over the years. I think there should be a bunch of charts. Offshore rig report. Now, if you go to Rystad Energy, you can look up all of these rig reports, and what you end up finding is that the day rates for ships for drilling rigs have never really gone up much. So after they crashed in 2015-16, people have been talking about how deep water is going to come back, but it's not. And I explained this over and over again, but it's a pretty simple supply-demand thing. Is that, Dave, help me work through this here.
Mm-hmm.
If you're a financial institution that normally has financed long-term oil projects, you know, 300, 400, 500 million dollar oil projects in the deep water. What's one of the requirements for loaning anybody money? What's the most important requirement for loaning somebody money?
Usually a down payment and collateral.
Well, that you're going to get paid back, right?
Right, exactly.
Right. So if I'm going to loan Dave money, I want to know that I'm going to get paid back.
Yeah.
If Dave loans me money, I'm going to find out where the non-extradition countries are, right? So, see, Dave, that was funny. Come on, you gotta be a little bit better straight man than that. Okay, so if the big banks like J.P. Morgan and BMO, which has been big in oil, know that in about 10 years the demand for oil is going to start turning over, why would they loan money on projects where it's going to take about 10 years just to get paid back? Right? Because some of these companies will go under in the meantime. So they're very careful. Even Exxon and Chevron, they're not putting a lot of money into the deep water, although Exxon's about to pour a whole bunch of money in Guyana, and I think that could be a very bad decision for them. Exxon is trying to grow out of the problems that I've been talking about that they have for the last 2 years. The problem is it's not a growing industry anymore. So
I think that might be the first to die off, the rig business.
Yeah, it's already going. You know, I made a ton of money shorting Transocean and Seadrill, and you know, I'll probably short them into the ground at some point. So in any case, Rystad is an awfully good resource for you if you've never used it before. I'd like to be able to show you the charts. I don't know where they stuck them now. This is a new website. It looks almost like the template that I'm using. In any case, so keep an eye on Saudi Arabia controlling this oil market, getting oil to be more expensive. And we have seen a rally already off the bottom. And then let's make this a shorter time period. You know, we've seen the little pullback, and now it's accelerating again. You saw money flow come back down, and look at this, leveled out. Looks like it could ramp back up, right? I mean, it could fall off a cliff with bad financial news. And that comes down to the trade negotiations. I think trade negotiations could turn a lot of things straight down, like in December. So that is why, as an investor, you probably don't want to be fully invested right now. You want to be in the best stuff. Energy and technology are leading, industrials too. But everything could turn over if there's no trade deal. So I would probably go net negative the market. I'd have more short positions, more put positions than I do long positions if there's no trade deal. So keep an eye and an ear out for that if it happens. But if we get a trade deal, I think another big rally, right? This isn't oversold, never overbought, never got overbought. See this go way up here. Stretch this out a little bit. I'm having a mouse problem. Oh, I think I've lost. There we go. My mouse might need a battery. Well, I think we can see oil probably getting more expensive here in the future. And I have a dead mouse. Uh-oh. That means it's not just do you have a mouse. And if you can hear what's going on right now, it becomes a matter of, do you have a backup mouse? And I have a backup mouse.
Very well prepared. Nice.
Actually, well, that's okay. So I actually switched to one of those vertical mice, a vertical mouse rather than the one where you put your hand over it. I highly endorse the vertical mouse because your hand sits sideways and it takes all kinds of pressure off your wrist and shoulder. So if you're in front of a computer a lot, try the vertical mouse. Go on Amazon; they have them for $40. They're spectacular. So Let's take a look at one of our favorite stocks. Let's take a look at Encana. This is a stock that I talked about with the Forex guys yesterday. You can see it just started accelerating.
Mm-hmm.
It's just about to get, yep, just about to get a positive divergence on the MACD. And it's coming off of oversold. I think this stock can really rally up here into the 8s. Might even make a run at 11. You know, this 200-day moving average. Again, trade deal dependent. If we get bad news on a trade deal, all bets are off. And I just want to keep saying that so people know. All right. So I had that screen. There we go. Let's take a look at this. So we take a look at all these funds, which ones have been doing best leading out of the fourth quarter correction. And is this one of the ones that you follow? You like bots? Is that one of them?
I think I've probably added that to one of my articles, but I don't think I wrote about it individually. Just,
okay.
It's a part of maybe technology.
Yeah. So one of the things.
Innovation.
Okay. So one of the things that we're going to do more of is the ETF files that I've written in the past, and really break down these ETFs based on the holdings and the industries. And what do you see here? An awful lot of internet or technology related stuff, but not exclusively. Transportation's done well, medical devices, industrials, energy is just starting to rally. Semiconductors have done well, aerospace and defense. You know, these are your leaders. These are the industries where I'll give you. I don't have the chart, and I have somebody else's report that I have to go through. Did you know that after a correction, the industries that break above their previous highs first, before the market as a whole do it, not only do they have a head start, but they tend to rally more than the index even after the index gets back to its highs.
Interesting.
So the fastest moving ones at the start of the move also tend to be the fastest moving ones as the index reaches a new high. So if the S&P 500 does set a new high, right, let's take a look at SPY. And you take a look at the fundamental chart. And in the last 3 months, you know, from 240-ish, I think it should be like 234. 234 up to today's 276. So let's find the handy dandy calculator. 276 minus 234 divided by 234. So the market's up like almost 18% from the very bottom. We can overlay a couple of these funds. So let's put TAN, SMH, and HACK. TAN, SMH, and HACK. TAN, SMH, HACK, and do you want one more? How about, and the industrials really have done pretty well. IYJ. IYJ. All right. And we'll normalize this. And who's done the best? All right. So what's on the bottom here? So the index is on the bottom. And all of these sectors have beaten the index by quite a bit. So somebody asked me about SunPower a couple days ago on Twitter, and said, how come it's languishing? And within days, it smashed it. First Solar has had a 20% rally. I will say that First Solar is one I was going to talk about today, so since we're there, I'll bring it up. First Solar has earnings coming up, and the consensus analyst estimates are basically spot on with the company. And one of the things that Zacks does, Zacks will tell you if the analysts are upgrading the company ahead of earnings.
Mm-hmm.
That's been a very good indicator in the past, and that's why the Zacks ratings are pretty good, is if the analysts are upgrading a stock before earnings, and there's a trend to do that, typically that means that the company is going to beat. And then that'll drive further gains in the stock. The analysts are not saying that First Solar is going to beat, and SunPower missed yesterday or the day before. But they had good guidance. So I suspect it's going to be similar for First Solar. I think that they're going to basically meet everything and say that things are getting better. However, I had a pretty large position in First Solar, so I've been writing covered calls against it. And the premiums are pretty fat. So if you own over 100 shares of First Solar, you know, it wouldn't hurt you to maybe write a covered call at 52.5 or at 55, take a buck or two out. And again, the right size for a position is somewhere between 1% and 4%. 4% is a very full position, almost never get there, except with growth in the position. But you're generally buying 0.5%, 1%, 2% for your portfolio. This position has gotten up to about 5% for me, so I wanted to pull it back to 4%. So I sold a little, and then I wrote covered calls against maybe another point or two. So, you know, those are the types of trimmings that you can do when you get a rally like this. And again, it depends on where you bought it. You know, my cost basis is like 43-ish, and I have some put premium in there too, so 41-ish, 40-ish. You know, and we made 20% pretty quickly. You know, in the past, we've owned this different times, right? We've owned some of these rallies, and First Solar, for whatever reason, I've traded it better than oil. We've avoided a lot of these big downturns. So if you have First Solar, even though it's a core holding for us, you may want to manage the position and take a point or two out of it. All right, let's go back to this chart. And again, this makes the point of what I said earlier. When the index rallies, the positions that rally first and hardest usually continue that move. So this is from the bottom. And what's orange?
Solar lead. Yep, solar.
Up there. Van Eck, semiconductors, and industrials. And again, I think industrials, I think this is speculation that there's going to be a trade deal. And then you've got the cybersecurity. So I wouldn't pick one of these. I would say figure out a way to have some exposure to all of them. The one that I'm going to have the least amount of exposure to is industrials, because I think a lot of that rally is baked in. These are capital-intensive companies. Remember what we've talked about? If you have to put $1 in to get $1.25 out, that's not as good as like a tech company that put $1 in and maybe get $5 out.
Right.
So keep that in mind. We want companies that get a lot more return on their invested capital. That is one of the criteria, and there's a guy on our website, Marshall, I think it is, it could be somebody else, that likes to follow Joel Greenblatt's magic formula from Gotham Capital. And, you know, return on invested capital is a big deal. So I have a modified version of that screen. I've created a lot of screens. Magic Plus. So his formula is called the Magic Formula, and I've augmented it a bit. So some of the companies I have on here are very similar to his, and I'm pretty aware of who they are. So Packer is on his list, Amgen, Applied Materials, Cisco. You know, Cisco's a holding for us in our one of our portfolios. Rockwell Automation right here in Milwaukee. I've told you, these guys, if you can ever get Rockwell Automation on the cheap, they're a big deal in supply chain. So that's a pretty good chart, isn't it?
Oh, that's a rock.
That's a good 10 years. You know, and so if you could have bought them in here, if you bought them on this dip, if you bought them way back here and held on to them, and you could just live with these movements, you know. So I've got another subscriber, and there's actually 3 or 4 that are, you know, basically bitching that, hey, I got in the summer and we just went through one of these. And I get it. I get it. I get it.
But you have to see where it's going.
But look at this.
Here, you know.
Right. So if we mainly own companies that go from bottom left to top right, you have to live with these types of moves. Right?
Hey, you're going to have your pullbacks.
Right. Yeah. So one of the guys complaining, he's a good guy, said he's been trading, or he's been invested in Apple for about a decade. Okay. Still had to live through this from 100 down to, and actually it bottomed at 57 split adjusted. And 57 is where I recommended in here on Market Watch to buy Apple. How's that? How's that for catching
call, man.
That was a good one. It would have been a little higher, but the editor took a couple days to publish it. But you know, so again, so 45% drop from Apple. Actually, it was almost 50%, but 45. 130 down to 95, 30% drop. 224 to 142. I don't even know what that is. Get that handy dandy calculator out. Now, divided by 224. That was a 30-second.
Wow. Yeah.
That's a big drop, big right? So, you know, if Apple is going to drop 37%, you know, let's put XOP on here. I'll normalize it, and we'll just do the last year. Okay. So I'm getting complaints about this, and I just bought Apple. Like we just bought Apple in here, but he didn't say nothing about his major holding. His other major holding, this guy, I believe, is Micron. So who are you going to complain about? I think it's a case of investors need to be less emotional and just realize what reality is.
Right.
Everything got the snot kicked out of it in the fourth quarter. That's just life. And now things are coming back. And in fact, Orange hasn't come back the most, but let's take a look at the last month. Come on, I need Orange to get in the lead. I'm screwed. So this is one of the reasons why I have been saying for a while now, look, the divestiture of fossil fuels is really taking hold, and we don't need to be thinking of ourselves as long-term investors in oil anymore. I mean, what's going on here? Oil should be way higher based on how profitable some of these companies are becoming, but they're not because the supply and demand for oil stocks, the demand for oil stocks is going down, and it's going to really turn over at some point. I just don't know that I want to own oil stocks past this next move up. I'm going to really have to reevaluate. The fact that I changed my entire business structure because of what I see coming in oil, and this is as being an oil guy for 25 years. I'm changing. It's because the evidence has led me there. Not emotions, not ideology. I have no idea where that chart went. There it is.
The reality.
But it's reality. It's just reality. Look. Last 10 years, let's put XLK in there. Technology fund. Right? In the last 10 years, if I just bought the technology fund, I'd be up 351%. If I had owned oil that whole time, I'd be even. You know, maybe another point or two because of dividends. Yeah. I'm just doing price here instead of, you know, we can even do price total return. Take this off. Look, I'd have made 10% in 10 years.
Yeah.
If I, so when I write articles like sell your grandpa stocks, this is why. The world has changed, and it's going to keep changing. It's going to change real fast. It's an exponential curve of change. It's not a straight line. And we have to wrap our heads around this, and we have to be okay with it. So we have to change our paradigm, or change how we think, and realize that, hey, the data supports it. So, something to keep in mind. I think let's finish on this. Our retirement income options portfolio for retirees. Now, margin of safety has kind of been all over the board in the past because with the new membership, and now we got about 300 subscribers. Now folks are basically telling me what they want, and what folks want is they really want a way to make money, but they don't want as much volatility. So we're focusing on that more now, and I'm spinning off other services for the aggressive people. So margin of safety investing is really going to be geared towards retirees and pre-retirees. And then I'll have
like dividend type stock.
Oh, right, Google's my favorite stock, and they don't pay a dividend, but I think they're going to spin off companies that are way more valuable than a dividend.
Right.
So I don't think people should be in love with dividends. There's a reason in the past why dividends won. A lot of those reasons don't exist anymore. These charts tell us that.
It depends on, if investors are looking for income.
Right.
Just growth in general.
But you can sell a share. And if your money's in a retirement plan, who cares how you make the money? And if your money is non-qualified, taxes matter. So capital gains taxes, and this is what Warren Buffett says. This is why Berkshire Hathaway doesn't pay a dividend. He says, look, if you need money, sell a share. You only pay 20%, capital gains tax probably.
Right.
Versus, at the moment, dividend taxes are a little bit lower, but historically, dividend taxes have been, been just regular income.
Yeah, or sell calls when it's oversold.
Right.
Or overbought, when it's overbought.
Right, exactly. You can write a covered call, so which would be the same rate as tax rate as a dividend, I believe.
Yeah.
So, do you want to be in the dividend payers just because they're dividend payers, or do you want to be where the biggest total return is? I think that's a conversation you need to have with yourself if you're an investor, because a lot of these dividend stocks, I can pull up screens. And I tell you right now, I've got a screen that basically finds dividend-paying stocks that are over-leveraged. I don't remember which one it is. I need to write better titles for some of these. But I have a screen that basically says, hey, these are companies that are paying out big dividends, but they're over leveraged and they don't have any growth. A company with a lot of debt and no growth is a company that will eventually be in trouble. And a lot of the dividend stocks that people are pushing on margin, on Seeking Alpha or Forbes or anywhere else, a lot of these companies are going to kick your butts, right? We invented a new acronym called FOGAC, fear of getting your assets kicked. Right, versus FOMO, fear of missing out, fear of getting your assets kicked. And you should be afraid of that. If you're in old capital-intensive companies that are high debt and they don't have a lot of growth, they don't have a real good return on invested capital, when the next recession comes, those stocks won't just go down. They're going to get crushed, and they're going to throw out their dividends. So I don't care if you're making 8 or 9 or 10%. There's one service that brags about having a 10% dividend yield. Okay. So that means in 10 years, you double your money, right? Unless you're reinvesting the dividends, in which is not really income anyway.
Right. What's happening to the underlying stock?
That's right. What if all the share prices go down 50%?
Yeah.
Right? I mean, that's an extreme, but during a recession, it probably happens. Yeah. So you have to run through your head, okay, what am I really making money on? Am I really investing in a company like Warren Buffett tells us to? Are we investing in a business, Are we investing in some imaginary safe uh, security blanket, right? My dividend blankie.
Mm-hmm.
So dividends make a lot of sense, but they better be able to pay for themselves, and they better be with a company that's growing, a
Yeah.
company that has a good long-term outlook. Nutrien is one of our stocks that we're in, or Intel, right? I like Intel. You better be in, oh, well, I can get a stock with a 4% dividend. Yeah, but do they have a growth rate? How is their debt? Right? And I think that people miss that over and over
Mm-hmm.
again. All right, we're at 50 minutes. Let's be done. I will answer some questions offline any second here, but I'll probably write most of them out. So have a great weekend. I hope you told somebody that you love them yesterday. If you didn't, do it today. And yeah, let's have a great weekend, folks. The market is rallying right now. There's probably going to be a small pullback. And if the trade news is good, you want to buy that pullback. If the trade news is bad, you probably want to sell. We did actually tell people to start doing a little. Whoops, latest. We did actually start talking about doing a little bit of trimming. So if you're a subscriber, read this article. It's not a bad idea to sell into this rally just a little bit, accumulate some cash in case the news is bad on trade. And we're probably going to get a little technical pullback, but it shouldn't be anything significant. But if you believe that the trade deal will get done, buy some of the winners. The chart's closed now, but buy some of the winners. Okay, buy stuff that is winning, that's actually winning, not just like pretend politics winning, but really winning. All right, everybody have a great weekend. Thank you very much for stopping in.
Great weekend, everybody.